One stock costs over $600,000 per share. Another costs $2. Which one is the better deal?
If you said the $2 stock, that probably felt like the smarter choice. But that instinct is one of the biggest traps in beginner investing.
Berkshire Hathaway, Warren Buffett's company, trades at over $600,000 per share.
It is one ventilathera of the most profitable businesses in the world. It generates hundreds of billions in annual revenue.
Meanwhile, plenty of $2 stocks are companies burning cash with no clear path to survival. The price tag alone told you almost nothing about the business underneath.
But that is what most people base their entire decision on.
Price is what you pay. Value is what you get. Most beginners feel safer buying a $2 stock than a $200 stock. It feels like there is less to lose. But that feeling is misleading. A low price on a strong business might be a genuine opportunity. That can happen during market crashes, during temporary bad news, or when a great company is simply being overlooked.
A low price on a weak business is just a risk with a small sticker on it. It looks affordable, but affordable does not mean valuable.
It would be, what is wrong with it? The same logic applies to stocks. If a stock is trading at $2, the question is never,
wow, that is cheap. The question is, why is the market pricing it this low? Here is a real example. In 2022, Meta, the company behind Facebook, Instagram, and WhatsApp, dropped from over $380 per share to about $90. At the time, it did not feel like an opportunity. It felt like something you should avoid.
Investors fled. But the business was still generating over $100 billion a year in revenue and was still profitable. The people who understood the business ignored the fear and bought at 90. Within 18 months, the stock was back above 500. This did not mean Meta was risk-free. The concerns were real, but the price drop alone was not enough to make a decision.
You had to look past the fear and check whether the core business was actually broken. 3 things to hold on to. 1 share price is not the same as business value. A $600,000 stock can be a great deal. A $2 stock can be worthless. 2, before you look at the price, look at the business. Is revenue growing? Is the company profitable? Does it have a real competitive advantage? 3, a cheap price on a weak business is not a bargain. In investing, the most dangerous risks do not look risky, they look cheap. That is the kind of thinking we are building at StockSava, understanding the business before the price. Send this to someone who still picks stocks by their share.